Chris Pendleton here, associate broker and short sale specialist with Tierra Antigua Realty in the metropolitan Tucson, Arizona. We specialize in short sales in the communities of Tucson, Oro Valley, Marana, Green Valley, Sahuarita, and also Vail. One of the most frequently asked questions is, and actually it's really a topic that a lot of homeowners don't really even think about, is what are the tax implications to a short sale or a foreclosure? Now, this information is general in nature, and we highly recommend all of our clients seek independent legal and tax advice because everybody's tax situation is different. In a normal circumstance, debt forgiveness is considered to be taxable. In other words, if you buy a house for $200,000 and you sell the house as a short sale or are foreclosed on at $100,000, in the eyes of the IRS, this is seen like a $100,000 paycheck, and they're going to want taxes just like you got a $100,000 paycheck. However, what we have currently, because of the current market conditions and state of the economy, is we have the Mortgage Forgiveness Debt Relief Act of 2007. And this allows basically a sum of up to $2 million that can be forgiven on your primary residence. The limit is $1 million for a married taxpayer filing separately. Debt also may be excluded through a mortgage refinance. The U.S. Congress or government provided this relief to these homeowners through the Mortgage Debt Forgiveness Act of 2007, and is actually expires or sunsets in the end of 2012. The information on this act can be found on the IRS website at www.irs.gov. It's important to realize that in this Mortgage Forgiveness Debt Relief Act is that this is for your primary residence, and it's used for a loan that basically to build, buy, or substantially improve your residence. So if you've done a refinance and taken out cash to actually improve your residence, that amount of money could be excluded in case of short sale or foreclosure. However, it's not included or doesn't cover things such as taking money out to pay credit cards or buy cars or boats, etc. No matter if you do a short sale or a foreclosure, you will most likely get a 1099. But depending whether you do a short sale or foreclosure, which 1099 you get will be different. For example, in a case of a short sale, you typically get a 1099-C, which is for cancellation of debt. And with a foreclosure, you'll get a 1099-A, which is for abandonment. If your debt doesn't qualify under the Mortgage Forgiveness Act of 2007, your debt then could potentially qualify under an insolvency exclusion. Insolvency happens when the debt liabilities exceed the fair market value of the taxpayer's assets. It is absolutely critical that you seek independent tax advice and that you don't have any surprises at the end of the tax year, because everybody's situation is different. So we highly recommend using a CPA who has been experienced with short sales. In facing foreclosure, you do need the best tax person, the best attorney, and the best real estate agent on your side. Call us today for a free consultation on the short sale process.